Hello and welcome to my morning note. Let's take a look at things from the bottom up today. It's plain that if you look at the main US indices, stocks are at or near all-time highs. But what happens when you actually look from the bottom up? Is there value there, and do you have any good clues as to the stocks which should be avoided? With me now to discuss this is one of the best in the business, the quantitative strategist from Société Générale, Andrew Lapthorne. Andrew, thanks very much for being here today.
No problem.
Let's start by taking a look at two of your favourite screens. What we're looking at here is the number of stocks that pass your criteria in the MSCI world, which is what, some 1,000 or so stocks. Yes. Take us through what the deep value screen is to start off with.
The deep value screen is not mine. It's based on the work of Benjamin Graham from his book Intelligent Investor. It has 10 factors in it, which simply 5 of them are based on, is the stock cheap? And then 5 factors which look to see if a stock is risky or not. We simply combine the two to come up with a short list of stocks which look attractive on a valuation basis and have basically below average risk.
Okay, and so at the worst of the crisis in early 2009, you had more than 200 stocks that actually looked like a buy on this criteria. And last year, it looks like there was another buying opportunity which has now largely been extinguished.
Yes, to a certain extent. I mean, we had 150 stocks we could buy a year ago, courtesy of markets rallying since then. That number's dropped down to about 50 stocks. I think what motivates someone to buy equities is whether they could find the stocks they want to buy at the right prices. So certainly it is the case that you wake up in the morning, you turn on your screen, you look to see what you could buy in the deep value space, and you're far more limited to where you were, say, 12 months to 2 years ago.
And now let's take a look at this blue line, the quality income stocks, which seem to be even scarcer. Just take us briefly through what that screen tells you.
This is a simple process of identifying good quality stocks at the right price. This is a pretty stable universe and far more limited because you're looking at quality first. Typically we have 50 names to 75 names in that type of universe, and somewhat distressingly from a bottom-up market valuation point of view, you have the lowest number of stocks that you could buy on that criteria for the last 10 years.
Okay, so maybe we shouldn't be getting too excited just at the moment. Now let's take a look at stocks to avoid. You've been doing work on earnings quality, which is an analysis of how much companies might be taking licenses to manipulate earnings. Take us through what this chart tells us.
What we look at is the quality of earnings being generated. Is it coming from the cash flow statement, or is it coming through accounting tricks? What we tend to find is those companies who use accounting tricks to boost their earnings tend to underperform the market by around 3% per annum in most years.
So this is things like revenue recognition or depreciation allowances, the things they tell you about in
Indeed,
in
things like receivables, inventory, asset revaluation, all these kind of things which are a little bit opaque.
Okay, so what this seems to show then is that going back to 1990, we only have a couple of years in which those companies which have been taking a license have actually outperformed.
Indeed.
So it might give you a nice pop to manage your earnings for a matter of weeks around the quarterly announcement date, but over any kind of a longer term period of as long as a year, it looks as though you really do need to avoid these companies.
I think everything eventually comes out in the wash. So certainly you're getting a benefit by simply identifying these companies and then avoiding them in the long term.
Okay, Andrew, thank you very much indeed. I think the takeaway is fairly straightforward. If you look from the bottom up, it's already getting quite difficult to find any true value, even if there was quite a nice buying opportunity a year ago. And there is some very interesting research here to give you an idea of those stocks which really should be very desperately avoided.